We have a wonderful conversation. It's been an industry trend for some time, and we've been wanting to cover this topic. And really, the core of it is this great convergence and bridging the wealth and retirement planning, retirement opportunity that's ahead of us. And so, a few quick housekeeping matters before we get rolling. We are recording today's conversation and intend to share this insights with you following today's session. Um, as always, there's a great opportunity to engage our esteemed panelists. Use the Zoom chat box to share your questions, anything that comes to mind, and I'll prompt you throughout today's conversation to jump in and ask any questions that may be top of mind. All right. To get us started, I'd like to start with introductions of our panelists, starting with Bonnie.
Good afternoon, everyone. Thank you so much for joining us today. My name is Bonnie Treichel. I am the founder and chief solutions officer of Endeavor Retirement. We also have a sister firm, Endeavor Law, and we help advisors, both wealth and retirement, with compliance and legal needs. So excited to be here and share some of our insights today.
Thank you, Bonnie, and welcome. Michael?
Yes, hello everyone. Excited to be with you today. Looks like there's a great sized audience here. Super exciting. Michael Dozier, head of retirement for LPL. We are the one of the fastest growing and one of the largest advisory firms in the United States. And my responsibility is to make sure that our retirement plan business, as well as our retail business, meets the needs of our advisors and the investing public.
Wonderful.
Great.
Fred?
Fred Barstein, CEO, founder of Trial, the Retirement Advisor University, TPSU, the Plan Sponsor University, and 401k TV. I'm also a contributing editor for wealthmanagement.com, their RPA channel. Our focus is today is about helping plan sponsors to fulfill their responsibilities. We do 50 half-day training programs all over the country, working with local advisors, and we're also doing advisor RFP, advisor searches for plan sponsors.
Thank you, Fred. Anurag?
Awesome. Thanks, Barham. Hi, everyone. I'm one of the co-founders of Manifest. Manifest is the easiest way to consolidate retirement accounts. Based out of Chicago here, it's the third company we've started, second in the 401k space. Excited to share more about how we're building the pipes between advisors, record keepers, to digitize transfers and help enable this big shift from workplace wealth into personal advisory wealth.
Fantastic. Folks, as you can tell, we've got panelists from all different cross sections of the industry. So if you have questions throughout the dialogue, jump in and hit us up, as they say. My name is Param, and I'll be your host for today's conversation. And for folks who haven't come across InvestorCom before, we are a leading software provider across North America, and our award-winning platform is foundationally based on intuitive solutions that build on compliance requirements to accelerate growth in the wealth management practice. Let's jump into the agenda. We're going to start with this wealth and retirement planning convergence trend. What's it all about? What's the size of the opportunity, and how can firms execute on this opportunity? Next, we'll explore actionable strategies where compliance can act as a catalyst for growth. So we'll touch on a few industry trends that are happening and what we're seeing in the marketplace. And then finally, we'll look into the future and see what are some steps that firms in this space can do to accelerate their growth and build trust and resilience, and obviously create long-term value for their clients. As I said, we'll have got 15 minutes at the end of today's session to take up any questions that may come up throughout the discussion. Okay. Let's jump right in. There is a convergence trend. Now, before we jump into the Q&A, the questions for our panelists, let's start with our first poll question to warm up our audience and hear your insights. Curious what you're thinking, where your firm is at with respect to this convergence trend. I see everyone responding and the numbers are just accelerating really quickly. Let's give this a few more seconds. So the question is, where is your firm today in integrating wealth and retirement advice? Is it fully integrated, partially integrated? Is this just the beginning? Or perhaps you're not even looking to integrate? See that we're at 70 respondents. That's a pretty good sample size. I'll end the poll and share the results. Interesting. It looks like folks are beginning to look into this question. There are folks who are partially integrated, which is a positive piece of data. And then, fortunate for some, there is some fully integrated firms in our audience today, so we'll know who to ask questions. Let's start there, and I'll stop sharing, and maybe I can jump into our first question, which is, wealth and retirement are converging through rollovers, workplace wealth, and the clear value proposition of holistic advice. Michael, as you mentioned off the top, it's one of the largest wealth firms in the world. How are you seizing this trillion-dollar convergence opportunity?
Thanks, Parham. Couple of thoughts. One, let me start with a reaction to what I just saw in that polling question. Not surprised based on my 1 year here with LPL. I've been in the industry for a long time, but just been with LPL for a year. As I go out and talk to our advisors, of which we now have 30,000 of them across the United States, I think I saw about the same distribution. I think convergence of wealth and retirement for many advisors is not a new topic, right? Those fully integrated firms that have figured out how to be more front footed, I like to say, from an integrated, holistic planning. We know you're out there, right? And I think the investing public benefits greatly from that focus. So now I am here to try to do everything I can from a home office standpoint to support that journey for our advisors. We are trying to be very centralized from a support standpoint, giving independent advisors the tools they need to activate this opportunity. I do believe that the best way for us to help advisors, and I think the crux of the issue as I see it here, or the opportunity I see it, is where we engaged you, Parham, and our relationship with InvestorCom to make the process as standardized and repeatable and consistent as possible. I think that helps everybody in the equation, especially the advisor, from meeting the compliance requirements as they continue to shift and move around between the fiduciary rule versus Reg BI and where do we stand on this equation. Wherever we go, whatever happens next, because certainly more will happen, and I'm hearing it will happen in the next couple of months. There's still a consistency answer, and there's still a process orientation answer. So I think that at the very core of it is the answer to the question from my standpoint. I know that advisors often do not like things that are considered to be process centric, that are going to slow them down from the time they spend engaging with their clients on the topic at hand. But I will tell you, since we launched the rollover analyzer tool here at LPL last November, of those 30,000 advisors, I've already seen almost half of them, just shy of 15,000 advisors, have already engaged with the tool, and they used it over 60,000 times. So that tells me that the average advisor gets that value proposition. And so I think we start here, right? We look for consistency, we look for compliance, we look for process, we look for documentation, and then we figure out how to take that to the next level from a scale standpoint.
Wonderful. And you know, those are real numbers. 15,000 advisors, 60,000 rollovers being made, and that type of advice, and I'll call it holistic advice, is exactly what's at the forefront of today's conversation. Um, which brings me to my question to you, Fred. You called this emerging trend, I want to say decades ago. Where are you seeing leaders seize the opportunity from your perspective? And do you see weak processes from your conversations with your clients?
Yeah, I don't know if I'd say decades ago, um, I started Napa Net in 2011, and around 2016, I really started seeing this trend. And that's when I decided to work with investment news and now wealth management because I wanted to reach a much broader audience than sort of step outside the 401k echo chamber, which becomes very redundant there. And sometimes I get accused of I don't write about anything else but convergence. And I just think it is um, the most and number one most important trend because as plan fees for record keepers and advisors decline and continue to uh, those that are able to work with participants, IRA rollovers are a very obvious one. Managed accounts and other ancillary services and financial services um, as well are important to do that. But that makes, for the retirement plan advisor, that means they have to move from fees, funds, and fiduciary to other services. For the wealth advisor, they don't really like the 401k plans and 403b, the fees are low and there's lots and lots of work and they're not specialists. But those who can figure it out, they're better positioned to uh, do the wealth and financial services. And I think that middle group, the advisors, retirement plan advisors, which are about 70% who are trying to pursue wealth opportunities, and the wealth advisors that have a significant, 30 to 50%, 60% of revenue retirement, those are the best positioned. Especially those wealth advisors that have some ability to do retirement. Um, and then the whole process of data, marketing, reaching out to the participants. There's only a few firms that have really, maybe one in particular that's done a really, really good job. Others are starting to catch up.
Wonderful. And you know what? We'll cover the sort of the nitty-gritty, or we'll jump into the industry research around this particular topic. But what's becoming more and more evident is a lot of advisors are, in a way, leaving money on the table, if I could call it that, or wealth advisors. In fact, um, what we're seeing is that a lot of advisors are basically, because of the frictions that are placed in the process, call that compliance and regulatory, are effectively saying this, there's far too much friction for me to worry about this. And so perhaps we need to just close that line of business and the opportunity of providing holistic advice. Bonnie, and I know this is a topic that's, front and center for you. You provide advice on these very issues from a compliance and regulatory perspective, which is on the third furthest column here, but it's an important one. We've covered this topic of Reg BI and PT 2020-02. Michael mentioned it off the top as well. How do these emerging risks intersect with this convergence opportunity in the industry?
Well, there's so many different aspects of it. I think Michael hit on it right off the bat, which is, for the advisor, that person in the compliance seat or the person like me is known as like the impediment to doing business in this situation, right? And so, really, the opportunity is to figure out how to, and I think Michael said this, how to create less friction, more consistency, stronger process that makes it easier for the advisor to be able to go from that retirement to wealth opportunity in a way that doesn't pressure the advisor to not do what's in the best interest because the rules are in place for a reason. We don't want to be encouraging advisors not to do what's in the best interest. Like that's a risk here is that we get so focused on the opportunity that we don't do what's in the best interest. Yet at the same time, we don't want to create just mounds of paperwork that really aren't good for the end investor and they're not good for the advisor. So that's really the opportunity. I think one thing I did want to clarify, and we talked about this when we were preparing a little without getting too far in the weeds. And again, Michael mentioned like more rules coming. I think it's helpful to level set just briefly on PTE 2020-02. So you have that on the slide. I think there's a lot of misconception around, is that alive and well? And the short answer is yes. 2020-02 is still on the books. You still have to follow it if you're choosing to use that exemption. So 2020-02 is an exemption. If your firm has decided to use that exemption from the prohibited transaction, then you need to still be following that. So that's largely going to come up in the rollover context, but that is still a valid exemption that you can use. There's been some changes around some of the FAQs that apply to that, but again, that's still alive and well. So just keep that in mind. And the other thing to keep in mind is do what's in your firm's policies and procedures, because again, as we've had this back and forth of the fiduciary rule for the last decade, your firm has probably adopted or should have adopted policies and procedures that match that and associated forms. So they might have taken an approach that adopts 2020-02, and maybe they've even taken some other heightened approach. Just make sure you're following that. But in short, 2020-02 still applies. And I would say be on the lookout for, even though the last iteration of the fiduciary rule, essentially that's no longer where we're looking. We likely will see, to Michael's point, some other version of the fiduciary rule coming soon. We'll probably dig into that into more questions later.
Absolutely. And again, folks, as a host, I have to keep reminding you to pop in your questions throughout today's conversation. This is really interesting because as folks have alluded, the rules of the game have changed. There's been ups and downs. Anurag, you mentioned you are a three-time founder of companies. In this particular area, I can attest that you have very, very unique expertise. How does today's infrastructure allow or perhaps not allow firms to scale advice, in your view?
Yeah, I think that's definitely a theme in all of the startups that we've founded here. And it comes down to a trend in the industry, which is back office operations aren't a competitive advantage. They're a cost center. And those firms on the advisory side that build out their own stack manage it really well to provide advice in a more user participant centric, user centric, client centric sort of way, differentiate themselves, and then end up building more wealth long term for the clients at the end of the day. And so there are a couple of things, I guess, to piggyback off of what Bonnie just mentioned. I do think the compliance is table stakes and something that is in the best interest of participants. The compliance is there for a reason, but then there's an opportunity that she mentioned to actually help convert that participant at a better rate. When it comes to operations and building that infrastructure, that does mean removing hurdles, paperwork, manual processes for that client so that they can end up taking that action to grow their wealth at a much easier and seamless way.
That's what it's about, right? Anytime there's any change in the industry, anytime there's an emerging trend, potentially new regulatory changes coming down the pike, I think there's an opportunity for folks to look underneath the hood and say, is there, as LPL has, as others have, is there an opportunity for us to take advantage of this opportunity? So, with that, let's jump into our second poll question. If I could ask for your help, Ankit. And the question, folks, is how does your firm approach the rollover advice opportunity? Is it mostly manual? Is it a mix of manual and tech-enabled? Or do you have purpose-built end-to-end technology and you have a high degree of confidence around it? Speaking of technology, just watching these numbers ramp up live, it's pretty remarkable. Let's give this one more second and I'll pop the results on the screen for everybody. Great participation. It's looking like there is majority are saying there's a mix of manual and tech-enabled solutions. Some folks have purpose-built workflow technology, which is fantastic, but still 23% of the respondents suggested that it's still a manual process. So there's good opportunity out there. So speaking of opportunity, maybe it's it's sort of a good segment for us to jump into a layer deeper and encroaching on this topic of why are rollovers the bridge that allows folks in the financial advisory practice to really look at the organic growth opportunity in front of them. Michael, let's start with you. How are firms, in your opinion, evolving beyond the policy that's somewhat prevalent in the industry around this is just an educational exercise to providing that an option to provide advice in their practice?
Yeah, thanks, Param. Well, I'm sure there's people taking screenshots of your data points right now, Param. I think it doesn't take anything more than the size of this opportunity and how much it's grown to get the attention of any, reputable advisor in the marketplace. By the way, quite pleasantly surprised to see the answers to the second question because I would have guessed more would have been in the full manual mode. The mix and the custom solution, I think that's great. I think that's a testament to this profession and both the wealth side from an advisory standpoint as well as the retirement plan specialist side truly converging on this topic. It is the place where it all comes together. I do believe that the shift, I think the history of most firms taking kind of an education only stance was one out of defensiveness from a compliance standpoint and the historical difference between the needs to meet compliance requirements in plan and out of plan, which I think to Bonnie's point, most of that is in the rearview mirror, the vast majority of it. I think whatever changes we do still do have in front of us, it won't challenge that. I think most forward thinking advisors, most forward thinking firms have moved more into that position where they're embracing the fact that this money and movement is a huge opportunity. And the best way to activate it is to truly integrate a more robust advice delivery mindset rather than an education only mindset. And to the extent firms that are ready to invest in the infrastructure, which again, positively affirmed in the survey question, you can structure that, put the documentation together, have the process and procedure steps in place. That then allows the advisor to be more focused on the actual engagement with their clients. It lets them really, truly focus on articulating the best in class solution. Because remember, as an advisor, I'm probably preaching to the choir here, the framework allows you to not think about whether you're going through the checklist on fees before and after the transaction, features and services, and really just lets you put the holistic picture together and engage with the client on what their needs are. But I think again, as long as you can do that in a strong methodology, compliance is naturally taken care of. And again, it lets the advisor focus in on you, the client, and what you need to make that happen. I do think, that one last comment I would make, I think the historical point in time, rather than an ongoing relationship, forced the rollover transaction and conversation to feel different than a ongoing service delivery transaction or a service delivery engagement that's relationship based. And I, again, think that now, since in plan and out of plan are more and more coming together because of other technology and other changes in the marketplace, I think it definitely makes it all more harmonious. And the advisors I see that do it well, this doesn't kind of stand out as a unique transaction. It's just more in a ongoing relationship flow that happens between them and their clients.
Absolutely. Thank you, Michael, for sharing that insight. Um, I got to say this, and Bonnie, I've got a follow-up question for you. I remember during the early days when there was that back and forth between, I'll call it the Biden era fiduciary rule. We were speaking with regulators, and the one anecdote that was consistent across regulatory bodies, whether it was SEC, FINRA, or the DOL, was that, hey, you mean to tell me 5,000 rollovers were executed through your firm last year, and all 5,000 were educational exercises? And that's one question that, quite honestly, I think it needs to be more broadly disseminated in the marketplace. And I think that's a really good segue into asking you, Bonnie, where do you see firms make the most amount of, I'll call it, of, maybe they're having challenges around documenting conflicts, assessing alternatives, assessing costs. Where do you see the most amount of challenge there?
That's such a great follow-up point that you just made, because one of the notes that I put just in general for this question in preparation was systematic. So things that look systematic in nature are counter to what Michael was just describing, which are this like natural evolution of the client relationship, right? So, as Michael's describing working with a client in this ongoing way, what regulators don't want to see are things that look systematic in nature. So Parm, to the point that you just made, you did 5,000 of these rollovers, but yet every single one was an educational conversation. That just goes counter to what's probably naturally happening. Or likewise, I'll give the opposite of that. You did 5,000 of these rollovers, and in your rollover analysis, every single one of those resulted in a rollover when you went through the checklist because they were all in the best interest. You didn't reject a single one to say, actually, it probably was better to leave someone in plan. Now, maybe they all were, but if it seems that it's systematic, and so that would be one of the compliance pitfalls that I would identify, are things that look systematic in nature. We automatically roll every single person over because we found a way to run a checklist that it's always going to result in the best interest of someone to move them from the plan to our IRA solution. Those are the types of things that systematically are red flags for regulators. Other things, and this might apply more to some smaller or mid-sized firms or advisors. There's lots of rules come out, and this might happen as we think ahead to a future fiduciary rule. Rule comes out, we know we need a new set of compliance materials. We go hire someone, they give us our new policies and procedures and forms, but we never actually tailor them or adapt them to our actual firm. That's another huge red flag, right? Because then we have policies and procedures that under the SEC, those have to be reasonably tailored. So that's a problem. And then we have policies and procedures or forms that we don't actually follow. So those are other kind of examples, along with this idea of just making sure that if we say we're giving education, we're actually giving education. And education can be a fine approach, but make sure you're actually doing that and you're not actually giving advice and crossing that line into advice. And we can talk more about that in the Q&A if people have questions, but I think those are some of the typical red flags that I see.
Thank you, Bonnie. That's fantastic, and I see questions coming in, so that's a great sign that we're nailing the topic here, and maybe this is a good turning point to sort of look at this question much more so from a practice management perspective. Fred, what behavioral gaps, in your opinion, prevent consistent focus on rollover execution?
Well, I think it starts with data, um, and not just getting data about the participants, but when that event is happening. Because if you don't do it immediately, you're going to miss the opportunity, which brings into the issue if the record keeper and the advisor are interested in capturing the rollover, there's potential conflict, which I actually just wrote about this week. Is there a middle path um, on that? I think. If you can get the data, which is the oil to the engine, and if you don't have the fuel, you have a great car, everything's waiting, and you can't go anywhere. I think secondly is engagement. You need to be engaging and in front of these participants early and often, and there's different messaging for different demographics on that. And so, if you only engage with them when this is the first time they hear about it, when they're moving and they're terminated, your chances of success are very, very limited. And then I think we've gone from education to guidance to advice beyond advice. It's not like, here's what you should do, actually doing it for them. That is the final, like, okay, here's what I recommend. Does that make sense? Great. We're going to do it for you on it. So I think finally, the some of the issues are how do I deal with small accounts, right? That's where like an InvestorCom or some other firms are helping that advisor. We'll do that for you, and compensate you. But most of the accounts are going to be smaller. It's just the 10-20% where the advisor thinks, okay, this is worth my time or somebody on my staff. So those are some of the things. And then, finally, I know there's been a couple of questions about Pantera. The question is, are people going to leave their money in their account because they have an advisor who's helping them to manage that as part of a holistic approach and they're, accessing and rebalancing that account? We're seeing, those third-party asset man held away doing very, very well and growing rapidly.
Yeah. Well, there's that ultimate practical question of I've provided the advice or I've educated my client. Now, how does this actually execute? And I think, Anurag, this is a perfect segue into your practice, your area of expertise. And in your opinion, what's really kind of slowing down that process of having funds flow from, retirement accounts into IRAs, and how can technology help, make that process a lot smoother?
Yeah, definitely. I think, yeah, to the points brought up by the other panelists, when answering these questions or these segments of questions, the sort of focus starts with the relationship that between the advisor and that user there, and the advice, the education, the different components to meet or exceed compliance requirements so that we're protecting the user's assets are extremely important, and then culminate to that action point, which is in this case, in our case, it manifests rolling over those assets to a current and active account that the participant voluntarily chooses to actually consolidate into. And so there are quite a few hurdles involved in that transfer journey. Actually, from the participant's perspective, we like to categorize them into three sections. Two of them are sort of handled through that relationship that the client has with advisors. The sort of decisions, the terminologies that come with just that rollover process. But the third one, which is those administrative hurdles, um, actually boil down to how our industry as a whole is structured. Data sources are from different areas. Sometimes it comes from a regulatory perspective. Employers can be involved, plan sponsors, because we're talking about rolling over generally, oftentimes from a defined contribution account. There's that record keeper who has some data on that part, and then the participant also has some data about themselves there, and the combination of standardizing all of that through that process is oftentimes put on that advisor and participant directly there, and that requires a lot of phone calls, a lot of paperwork, sometimes following different rules that where the goalposts change quite frequently. One of the things that we try to do is standardize that journey. It's a live. It's sort of like the journey is just like human. At the end of the day, it's alive and changing and dynamic, and so it's really important to just make sure that we're standardizing, collecting these pieces of data, assembling them in a way that meet uh, the regulatory requirements, but as well as like the operations requirements that each of these firms have to reliably pair the funds with the person's account at that point. So,
Exactly.
yeah, standardizing is the key there.
Standardizing, if there's a hashtag out there around this convergence opportunity, it's standardization. Michael started it from the top. I think everyone's touched on the same theme. And quite honestly, what we're seeing in practice, and some of the numbers are being flashed here on the screen, when that process, there's a higher sense of trust, there's a higher sense of confidence from a compliance perspective, it can actually be levered to enable business, to enable advisors to grow their practice. And the data that we started with was sort of the top of the line industry trends around $1 trillion or more that may transact, may roll over on a given yearly basis. What we're seeing across our client base, specifically our top 5 clients, not only doubles down on that trend, it actually illuminates it and says there may be more opportunities specifically in the advisor-led rollover space. So there is a lot more to talk about on that point around the element of trust in that process and what advisors can provide in terms of holistic advice. Let me quickly pause. There's a really good poll question I want to raise for everyone to participate in before we move forward. So, Ankit, if I could ask for your help. Thank you. So, what's limiting your firm's ability to take advantage of this convergence trend? We're looking at the same question from a different angle. Note to self, Jeopardy music would be good here, and you don't want to hear me singing, so let's give this a few more seconds. All right, I see the trend slowing down. We're almost at 50 respondents, which is a great sample size for the math geeks out there. I'll end the poll here and share the results. All right, what's limiting your firm's ability to take advantage of this convergence trend? 41% technology and workflow integration. It sounds like we are onto something here, but Bonnie, I've got my thoughts in terms of setting up the right organizational policy. Always starts there. Interesting. And by the way, what you're seeing on your screen, along with the poll results, is part and parcel of a insights document we plan to share with you, and you'll hear from my colleagues at InvestorCom as we go through this. Okay, so we started with the um, $1 trillion opportunity. We double clicked on um, the bridge being rollovers in that opportunity set, as well as what InvestorCom has been seeing in the marketplace. Now let's go a layer deeper and think about the longevity in that advisor-client relationship. But Fred, maybe I can come to you on that point. How are advisor and client conversations changing as a result of that holistic advice across retirement plans, wealth channels, and how does this relate to this topic being at the core of that client advisor trust dynamic?
Yeah, and before I start, just to honor our point, the rollover process and what we put people through to rollover is an embarrassment to our entire industry because we're not being compared to other record keepers or the participants are other consumer products, and it's just ridiculous. And so anyone who is ahead of that and looks at themselves as competing against consumer versus other so in terms of the trust, the workplace is going to be, according to Jamie Gorman, the former CEO at Morgan Stanley, the #1 place for financial advisors to gather to get new assets in the next decade. Now it's going to be 8 years since he said it, and it's because that advisor has been endorsed implicitly or explicitly by the employer. 95% of the participants on DC plans do not have an outside financial advisor. Partly it's because they don't have assets, but partly it's because 50% of all wealth is hidden and unadvised. 50%. So the opportunity is here to do this, and it shortens the sales cycle. Um, so as I had said before, uh, you need to engage with them, having group meetings, offer one-on-one meetings, having relevant, personalized communications with them when there's events, if your record keeper is cooperating, reaching out to them when they're getting married, they have a baby, they start saving for a college, those kinds of things. Um, but I think that also, as we said, it takes data process, but also people. There needs to be, in my opinion, there needs to be a whole new group of financial coaches, maybe not even people licensed, who are working with and maybe bubbling up opportunities. And there is no training, and there is nothing there for to train those out of college or maybe entry level people on how to be a financial coach focused on advice, not sales. On that.
That's fantastic, Fred. Thank you for sharing that. And hey, there may be new industries emerging as a result of this trend. Um, Bonnie, curious what your thoughts are on, as you're working with your clients, what does a defensible best interest piece of advice or educational exercise look like? And what role does, in your opinion, technology have in that?
I want to play off of two things that Fred said that I think are really important here. And maybe emphatically emphasize that technology can really help in that defensible documentation. But, Fred said, I think, Fred, I don't want to put words in your mouth, but I think he said something to the effect of like, it's embarrassing, the paperwork or the process that we require for rollovers. And I couldn't disagree more, or pardon me, I couldn't agree more. I couldn't agree more. Because it's not just about what's doing right in these cases. It's about being able to show your work. But our regulators have required so much paperwork and process to be able to show your work. So that's where technology is really going to be helpful, because we want to be able to show the work, and you have to be able to show your work, why you got from retirement plan to rollover. You have to be able to demonstrate that. But for that end investor, we need to be able to show it in plain English in a clear way that shows what is this fee, what is the value. And so, as Fred said, there's so much there that you're required to do, but through technology and through some very easy to understand disclosures, I think some firms can really excel against competitors when they can make it clear, plain English, easy to understand while still being compliant. The other thing that I think is really helpful, Fred, you mentioned a couple comments ago about all the different like levers that you can pull or revenue streams, things like managed accounts and other things. So I think one thing to keep in mind when you're looking for defensible best interest is when you are doing that comparison, being able to really demonstrate what was the total cost in the plan versus out of plan, for example. So again, just really making sure you understand and have that full picture, given that plans over time have really changed in all the different levers and revenue models in the plan. And that's different than it was long ago. There are a lot of levers in being able to show one versus the other, which I think is really important. So in sum, it's really about being really clear and plain English in those disclosures. And I think technology can really help with that. So especially if you're trying to scale it across many advisors.
Oh, Bonnie, this is this is music to my ears personally because as a solution provider in this space, we see all sorts of different practices, and I'm sure you have as well. We see 100-page documents. We see fillable PDF forms that have to be unfortunately filled out manually by wealth practitioners out there. And there is an easier solution to your point that can make this plain language, leverage this compliance opportunity. But let me ask the practitioners, Michael, as a firm with thousands upon thousands, I believe you cited a 30,000 advisor count figure. How have you been able to leverage this compliance requirement from a practitioner's perspective?
Yeah. Well, we're early days. We're 6 months in, but as I, mentioned at the outset, the volumes speak, I think, loudly. I do believe that in general, more proficient advisors that have an established practice, there's a couple things they hate. wasting time, wasteful administrivia, and change, right? And when we introduced this last fall, complete transparency heard a fair amount of noise because we were introducing change for some where they had a separate process, and we were introducing new administrative tasks for some that didn't have a process. For both of those groups and for my own partners internally at the home office, the change was in mindset. Don't think about this as a constraint or a burden, but think about it as a step towards growth from an infrastructure standpoint. And so standardizing the process, giving advisors a framework that they can have confidence in that will lead to the outcomes that are compliant and allows them to stop thinking about all the compliance steps and allows them just to think about the engagement with their end client and what their needs are and making sure everything that matches up, right? I do think the firms that get that right, that will become a competitive differentiation because scale will come because of the efficiency and not having to circle back because you found some compliance errors or breakage. And you can just focus in again on the clients in front of you. As we move more into this equation from not only a compliance documentation standpoint, but more to an automation of process and procedures before and after the rollover, I think that's where the real game will be won over the course of the next 3 to 5 years.
Wonderful insights, Michael. Thank you. Anurag, quick question for you before we jump into our last poll question, and I want to keep our promise to our audience on taking up any questions that have come up. So, how do you see it as the industry clearly looks like there's an opportunity to leverage digital solutions?
Yeah, I think it has to do with scale at the end of the day. And if any company really wants to scale, they have to focus. And then just to piggyback off of what Michael just mentioned, we've seen something very similar on the advisory side. There's sort of two areas of focus. One is on that building a trusted relationship between the client and advisor. And second, it's about executing on the wealth strategies. And that's the second part of execution of those strategies is where companies like ours play a role. And sometimes they need to be sort of combined with different technologies as well to make sure that the entire process from the client perspective, the participant, the user perspective is unified. It's set up in a way that is cohesive on that front. I guess when it comes down to execution, our philosophy at Manifest has always been to um, the finance is something that enables people to live their lives, should never control their lives there. And so speed is one of those things that matters. So turning something like that rollover process as far as effort and processing time from like 60 days, 7 hours of effort, to less than 10 minutes of effort over 7 to 14 days is always welcome so that folks can end up doing different things with their lives.
Thank you, Anurag. And we had plenty to talk about today, and actually, we haven't gotten a chance to get through all the questions, but it's proof to the quality of the conversation and engagement so far. So let's jump in with our last quick poll question. If you could, Ankit. All right. What role does technology play in unlocking the bridge between wealth and retirement planning? Seeing all of the above, that may be a cheat code to the question here. Let's give this 10 more seconds and I'll share the results with you all. As folks are doing that, I'll just quickly suggest that following today's session, you're going to get a prompt. You can just click on it and we'll send you the insights from today's conversation along with the poll results. Hopefully, it serves your purpose as well at your respective firms. I'll end the poll here. We've got almost 50 and share results. So apparently all of the above is the winning answer here with the unlocking factor appearing to be more definitively around support solutions that enable operational efficiency, which is, I think, the consistent theme here for today's discussion. All right, let's jump into our lightning round, Q&A lightning round. Here we go. You've got our wonderful panelists, folks. I saw questions coming in, and this is a good opportunity to jump into them. And if you have more, pop them into our chat inbox here using the Zoom screen. There's been some commentary as well that we've received, so we'll try to get to that. And if we don't, we'll follow up with you to dig a little bit deeper. I'll start with the shortest question that I see in front of me, and it's there's a sense of curiosity about how to handle obtaining fee information for IRAs and Roth IRAs. This is a massive holdup at my firm. Any tips or tricks from our industry panelists?
Michael,
If
are
not,
you jumping in on that one? I mean, my understanding is it's still a big gap in the industry. Retirement plan data is pretty readily available, but on the IRA side, it's still a gap in the industry that we're trying to solve from my perspective.
100%. That's
Yeah,
go ahead.
I don't have a whole lot to add, Bonnie. I think it is a gap. I know for me personally, settling in here, it looks like it is because even on the retirement plan side, where it is more readily available, it still might not be efficiently arrived at. I know we're trying to build infrastructure to funnel everything in on both sides of this equation for our advisors, but we've got a long journey ahead of us. So I don't have any real, unfortunately, no positive tips or tricks to make that more efficient coming from me.
I I will share as a technology company, we looked into that. There are some industry benchmarks out there, but what breaks the camel's back here on that particular point is there's a lot of fee negotiation that happens between the advisor and their clients. So even if we go with that industry benchmark of, let's just say your IRA is housed through Schwab, whatever custodian, there does tend to be that negotiation factor that changes the game from a compliance and record keeping perspective that creates a bit of a, I'll call it downstream challenge. But it should be something that the industry can get its head wrapped around and resolve. So that's a great question. Thank you for asking it. Another good question I just see in front of me is what's the panel's opinion on financial wellness tools and if they play a critical role for the advisor engagement with participants?
Yeah, Param, this is Fred. You know, we've unfortunately there's a great demand for financial wellness by plan sponsors, but it's also so ill-defined. I think the tools, just the tool themselves, without having a person, just like AI. AI may be valuable in providing advice, but it's not going to replace advisors. So I think that um, the tools are maybe a way to start some engagement to make these coaches or financial advisors more productive. But in and of themselves, the engagement and financial wellness without people is single digits and maybe low single digits.
Yeah, I would add, Param, on this one. I think that financial wellness has been such a vague and kind of ill-defined term over the years. I think there's probably as many definitions as there are people on this call. I'm starting to think now that more and more of the advisors represented here and in the industry work for firms or they personally have capabilities on both sides of the equation, both in plan and out of plan. I think that number grows every day. And I think to the extent the advisor comes to that table thinking about it as not financial wellness, but what's my full holistic advice capabilities from a wealth standpoint, and how do I layer that on top? That's the way I think most advisors are thinking about it. And I applaud that. I think the end investor will be well served by the fact that more and more of us think that way. Now, to Fred's point, how you do that from a engaging with the plan sponsor so that it's clear on what the offer is. I think that's still a work in progress in a lot of places. I think some bigger firms have put some decent ideas out there on that front, but I think that I'd almost like to see the word financial wellness, the words financial wellness kind of fade into black. And let's just think about this as holistic servicing and planning across the whole wallet or purse, depending on the analogy you want to use for the client sitting across the table.
Absolutely. I mean, there is truth behind the fact that, is a held away 401k plan with, your traditional target date funds, is that the best strategy and best degree of care that a financial advisor provide to an average investor, right? And the concept of holistic advice sort of and financial wellness goes beyond and tries to intersect the two and say, well, with the advent of technology solutions, investor comp, I think there was a conversation about others and manifest, the ease at which and the fluidity at which that process and holistic advice can be provided is going to be way more valuable, way easier for practitioners to employ at their firm. So I totally agree on that trend. Speaking of which, there's been a bunch of questions that have come in around technology, and I think Fred, you touched on this a little bit off the top. Technology solutions that allow wealth advisors to manage held away accounts. Any thoughts on that? There's a lot of questions around whether your views on those solutions.
Yeah, I actually just had a call with one of them, Future Capital, today. Uh, by far and away, the most popular is Pantera, and they are allowing the wealth advisor to manage their clients' 401k. It's through credential sharing, so the advisor doesn't necessarily get the credentials. Those go to Pantera, but the advisor can actually do it. We've seen two big firms uh, shut them down, Schwab and Fidelity. And Schwab might say, well, we're not really shutting them down, we're just asking for extra credential. They're using cybersecurity issues. Not Probably not a coincidence. Schwab and Fidelity are looking to also provide wealth services and capture the rollovers as well. I think it was a very good article by Lisa Gomez this week. And she is a consultant to Pantera, is the plan sponsors cannot just let the advisor, the record keepers, dictate whether participants can use the advisor that they have, financial advisor, to help manage the account. It's a very bad look. So I think that whether it's through credential sharing or through API, or there's another firm that does it through uh, the self-directed brokerage account, prohibiting participants who have no choice on who their 401k provider is from using their financial advisor to help them manage their account is a big black mark against any record keeper that is not allowing it. They should be working with the plan sponsors and solutions to make sure the cybersecurity concerns, which are legitimate, are answered.
If I can piggyback off of that's 100%. The sort of case study that played out on the commercial banking side was open banking. The same points that Fred just mentioned came up with Plaid and JP Morgan, actually, and recently they ended up settling that sort of dispute. For me, it comes down to incentives at the end of the day, and we've all been talking about all this data within the retirement space. And a lot of it is held with that record keeper. On that front, the question is, how do these held away account providers add value to that record keeper? They 100% do to the participant, in my opinion. I think Fred in the previous answer also mentioned that assets grow if they're managed in a more customized, personal way there, and it grows sort of balances there. But building out those APIs, protecting that data from the user perspective, from the record keeper's perspective, is very important. Injecting credentials requires, from a technology perspective, more developers, processes, a setup which comes with costs, which also mean different maintenance things longer term there. So.
Fantastic. All right. We're right on time. This was a perfectly coordinated conversation. 2 p.m. on the dot. Michael, Anurag, Bonnie, and Fred, thank you very much for your time. We're